we come up with reasons to justify high valuations at the point where the fundamentals don't necessarily suggest it. Meaning you start grasping for straws as to why valuations should trade at ever higher multiples. So when we think about today's environment, we're at 22 times forward earnings, 38 times forward on a CAPE ratio. These are historically very high multiples. And the justification that people have been using for those multiples has been, well, look how high quality the market is now. Look at these software stocks with their strong recurring revenue and tech stocks with high free cash flow and high return on invested capital. And what's fascinating is those are the exact things that we've been questioning the most as a market over the course of the last few weeks. So it's good to remember that those famous last words tend to bite.
So starting in late October, maybe early November, we've had what a lot of folks will say is a rotational shift, maybe out of some of those growth names, maybe into some more value, more small mid cap. Is it a rotation, which is one thing, or is it a risk-off call, which is another thing? And that's, I know you've been thinking about that.
Yeah, I would call it even more than a shift. It's been practically a tsunami, and that's been because if you go back to October, you were at max long, large cap, mega cap growth, and you were max short these cyclical areas. So a lot of this move has been effectively a pain trade out of past winners into the past losers. I think the question is, do we take any economic message from this rotation? Part of the things that have been doing really well have been the very cyclical risk-on parts of the market, industrials, materials, energy, but don't also forget that we've been seeing really strong rallies in consumer staples. So you have to raise a little bit of an eyebrow of, is this equity market telling us we should be more concerned about the consumer?
So if I got Kraft Heinz today with some huge announcements like it's not working, we're not going to go forward with the split up of our company. I'm bringing this up because Cameron puts down up in the food court.
Yep.
The way she chows down the Kool-Aid in the food court.
My favorite food group is ketchup.
Is ketchup? Is really?
Yes.
Do you buy the fancy snobby one at Whole Foods?
I buy
all 57.
The organic Heinz. Kraft Heinz.
Organic Heinz. Oh. Yeah. They have that. I didn't know
they
had
that.
that.
They do.
I didn't know they
And
had
my
that.
second favorite food group is macaroni and cheese. So I like the spirals.
And don't give me this Annie stuff. If it isn't Kraft macaroni, it's not the real thing. Thank you. We digress. David Rosenberg publishing moments ago up in Toronto. The Grinch showed up at Christmas time. Santa was a no-show. How do you filter the gloomy news if you're gung-ho high-tech?
Well, I think the big question of what has been driving this market higher has been really strong corporate profits, margins surprising to the upside over the course of all of 2025, despite the tariffs. And I think the reason is because companies have been pulling back on hiring. They continue to grow sales, but they have not added to labor. And that has resulted in a weaker labor economy. The question is, do we have a tragedy of the commons type moment? Meaning that if everybody's cutting back on hiring in order to be able to boost their margins and insulate higher costs in other places, do we eventually see that trickle down into a much weaker consumer, which we know the U.S. economy is 2/3 consumer spending, and then we end up effectively cutting off our nose to spite our face?
We'll get a little reading today at 8:30 on the jobs. That's a big part of it. I tell you, something you don't see very often is the equal-weighted S&P up 5-6% versus the XPX, which really factors in the tech. That's only up 1% this year. How often do we see that?
So the last time we saw it in a sustainable way was back in 2022 because the majority of the market weakness was driven by those large weights that were tech names. And if you look at the Russell 1000 Growth Index, it's down about 1% for the year. So this is really capturing that, again, it gets back to the past winners are starting to come under significant pressure. The losers are bidding up. And the end result is that it's effectively a last shall be first kind of market. The question is, do the fundamentals support that kind of rotation to suggest that it can continue? Some of the earnings trends actually do suggest that.
Okay, this is where AI just rocks. Can we digress for a moment? She comes in here all fancy Alexis, and she's trotting out phrases from the 1830s in Malthusian theory. Tragedy of the commons, like everybody's out in the Garden State Parkway knowing what she's talking about. A wise one, brief us on William Forster in 1830.
Well, so the idea of the tragedy of the commons is that when each person acts in their own self-interest, it can actually hurt the whole. So usually it's in the idea of farming. If you have a bunch of people sharing a piece of land, they over-farm it, and it ends up resulting in a much weaker output in total. The same could be thought of when we think of the labor economy. If everybody's pulling back on hiring, do you end up hurting the overall consumption capability of the economy?
Then bring William Forster Lloyd, 1833, and Garrett Hardin, 1968, over to AI. What's the tragedy of the commons that we're heading for with AI?
I think the biggest question is, do we have a structural shift lower in overall labor demand, and that structural shift lower hitting services, meaning that if you have an economy that is predominantly driven by services, as the U.S. is, and predominantly driven by overall consumption from households, do you have something where AI, instead of being something that drives incremental growth, ends up hurting kind of the old way that the economy was structured?
One of the, actually, the first lesson I learned trading stocks at Payne Webber in the 80s was the falling knife. And if I love a stock at 30, it goes to 22. Now I got to love it here. And boy, that was the first big lesson I learned. I bet you a lot of software investors are thinking about that now, because here's a business that's forever has been a great business, been great stocks, recurring revenue, the whole thing. You get some of these names down 10%, 15, 20%, you go like, I got to be all over them. I don't know.
Well, Chris Verone over at Strategos always say, mistakes happen when you're underneath the 200-day moving average, which is meaning when you're starting to go and see trends start to deteriorate, that's when you have this potential of lower highs and lower lows, where you just get this selling pressure. I think for software, you have seen indiscriminate selling. You've seen headlines of just get me out. You've seen effectively people dumping things, shooting first, asking questions later. You got to oversold levels. You got down to support. That's supportive of some kind of bounce, but that's not necessarily supportive of these names reasserting leadership, which is two very different things. Could be that you play in software where you say, I'm here for a good time, not for a long time.
Okay, but, again, getting back to, we can do this, folks, on the Bloomberg Professional service right now. Our worst on a weekly chart, at NewEdge Capital, we use weekly charts because we're responsible. On a weekly chart, I have a Standard & Poor's 500 drawdown of 3.22%.
Yeah.
The market's absolutely crushed. What are we going to do when there's a 10% correction?
Yeah, well, it will be very jarring because it's something that we haven't seen in quite some time. And I think the question is, are the retail investors ready, willing, and able to buy that dip? Because they have bought all the dips over the course of the last 3 years. And what we have seen is that retail investors are now arguably all in on this market. If you look at margin loan balances, you look at retail stock allocations. And so are we still in a place where it's just buy the dip, close your eyes and buy? That seems to be the case and continues to be, but at what point is everybody on one side of the boat?